But first, the inflation data out today, not welcome news. Annual inflation pushed up to 6.8% in April. That's higher than expected. And this is up on the last month's drop that went down to 6.3. As you know, it's much higher than the 2 to 3% band that the RBA wants us to sort of hit. We're not anywhere close to it, are we? Joining me now, Sky News Business Editor Ross Greenwood. Well, the big question, Ross, what does this mean for the next RBA banker meeting? I think that's Tuesday. Do you think we're going to have a cash rate increase?
Well, if you go back to last week, money markets priced in 0% chance of a rate rise in the June meeting. It's now sort of out beyond 20% as we sit here now. And it's put pressure on the Reserve Bank, there's no doubt, because really the trend has been for inflation to fall in Australia, to fall back to this 2 to 3% mark, even if it was until early 2025. You want the trend to be down and not up. The problem is there's now signs, evidence that inflation is sticky. And given that, the Reserve Bank has got little choice but to try and get its cash rate 3.85% as it is currently, up closer to what the underlying rate is. And even in this particular sort of monthly inflation number that came out today, that underlying inflation, which strips out the one-off factors, rose from 6.5 to 6.7%. Now, give you a small example of this here, though, Peter. In America right now, their cash rate, their interest rates from the Federal Reserve are now higher than the inflation rate. Here, remember, 3.85 versus 6.8 is miles apart. And that's why there's pressure on the Reserve Bank to act on this inflation quickly and not to rest and wait.
I might add, in America, though, you've got a 30-year mortgage term, and that rate doesn't move in those 30 years. Here, it's like Russian roulette. Every time those inflation numbers come out, you can see that, particularly those coming off fixed mortgages, they're really under pressure. Phil Lowe was in the Senate estimates. I referenced this a little bit earlier. I thought he did well today. I mean, he's certainly batted back. He's under a lot of pressure, as you know. Let's have a listen.
We've increased interest rates a lot. Monetary policy is restrictive and it's working. And whether we need to increase rates further will depend not only what happens with unit labour costs, what happens with the global economy, with inflation expectations and consumer spending. So they're the variables that we're looking at.
I know the biggest issue is productivity, and it's such a nebulous term outside of people like you and me that talk for a living. I mean, people at home go, what's productivity? Yeah. Well, it's like getting into the office. It's getting workers back in the office or into the shop floor. It's about doing more when we're at work. That's the problem, and it's hard to fix, isn't it?
Oh, it's hard to fix quickly because that's about your public transport. That's about trying to get more out of every unit of labour you've got in the workplace. In other words, people might think they're working hard now, but it's actually trying to make them work more efficiently as well. And so he gave a very good explanation that even though the core wages numbers are very much subdued in Australia, because you don't have this productivity improvement, effectively it means that real wages or the unit wage costs are rising. And this is where, again, he says there is pressure, therefore, on inflation and, as a result, on interest rates to rise. So, this is something that Australia as a nation and the government in particular have got to address. But remember also, you've got right now big pressures for wage rises. The minimum wage rise comes out on Friday this week, and the government wants 7%. It wants inflation. So do the unions. And so that is only going to add to these pressures for wages and inflation to rise, which therefore puts pressure on the Reserve Bank to raise interest rates even higher again.
And if you're in a small business and you can't cop the 7% pay rise, you're going to have to let staff go. And we saw a slight uptick in unemployment. I think that worries people. I mean, there's one thing to have your mortgage go up. It's bloody hard to pay it if you haven't got a job, so that's a concern. And I've been banging on about this for nigh on a year now, this rapid uptick in our immigration, trying to catch up in a couple of months what we had in that the shutdown period over the pandemic. Now, this has been picked up, a well-made point today by the Chief Economist, Shane Oliver. Have a listen.
The problem is that we reopen the economy to immigrants very, very quickly. The problem with that is that we don't have the capacity to supply enough homes to the property market to house that number of people. And obviously that means higher rents. It's now meaning higher house prices. And that's a long-term ongoing problem.
And he made the point, Ross, that you and I have been making. Sure, increase your migration if you're going to do it, but please get the infrastructure in place. Have a plan to do it.
Oh, yeah.
And this is just basically a ramp up, and it's causing this huge pressure at the other end when people arrive.
So take it back to the Reserve Bank. And what were the pressures of this inflation that we saw? It's rents rising because you don't have enough accommodation. You're bringing in a lot more people to add even more pressure to those rents. We know that the construction industry is under enormous pressure right now because their costs have risen. And so ASIC, I think, said that there are 5 construction companies a day that are going broke right now, which doesn't allow you to build the houses you require to bring these new people into the country. So these pressures continue to build, which are all inflation, which add pressure for these interest rates to rise. So there's not one simple answer to this. There's myriad things that government needs to do effectively to try and get more accommodation built so that you can actually accommodate people when they come into the country.
And I'll just make one quick point before we go, Ross. The RBA's just got one lever. It's the cash rate, right? It's what we pay in our mortgages. It's all they have. Government's got an IR lever. It's got a minimum wage submission lever. It's got its own spending levers. It's got the pay rate, 15% pay rate to aged care. It's got a multitude of options to get this under control, to get inflation under control. But it likes to think and blame the RBA that it's all somehow Phil Lowe's fault.
Well, they're convenient to have the Reserve Bank there as, if you like, the one who can have the finger pointed at them. But you're right, government can do a lot itself in terms of its own spending and its constraint, but it takes longer to play out in the economy. The Reserve Bank can make moves quicker, that change the behaviour, change demand in the economy. The problem is the household sitting out there right now is paying higher electricity prices, is paying for higher groceries, is paying for a range of other measures that are rising, including state government taxes, remember, and so really they're just in no position to try and avoid these taxes and these cost hikes as they come down the chain to them.
Ross Greenwood, thank you.